Good afternoon, financial professionals, and welcome to the BREW, Building Relationships Every Week. My name is Jennifer Nadeau, Case Design Specialist here at E4. For those of you tuning in for the first time, welcome. We like to start off the BREWcast by recognizing what today's National Day is. And today is, from my home state, it's National Connecticut Day. It is also National S'mores Day. Shouldn't that be every day? And it's also National Lazy Day. However, I'm not too sure how lazy we're going to be here on the BREWcast today, because on today's BREW, we welcome E4's very own Steve Walker. Steve is the Vice President of Institutional Accounts at E4, and he'll be discussing the benefits and opportunities of Irrevocable Life Insurance Trusts, or ILITs. An Irrevocable Life Insurance Trust is a type of trust that can be used to help clients transfer wealth to future generations in an efficient manner. Most people don't want to pay more in taxes than they have to. But if you're a high net worth individual, you may have an estate tax bill due when you die. So stay tuned to learn what an ILIT is, how an ILIT works, and why an ILIT may be able to increase your client's legacy while decreasing estate taxes. And as a reminder, please feel free to use the chat box to share your thoughts or ask questions. Also, all attendees are in a drawing for a prize, and we will be announcing the winner at the end of the call today. Thank you for tuning in. And Steve, welcome. It's so nice to have you on the BREW today.
Awesome. Thank you for the great introduction, Jennifer. And I couldn't be happier that it's National S'mores Day. Probably going to have to fire up the old fire pit tonight and give a good excuse to have some fun around there later on with the kiddos. So
absolutely. Absolutely. So let's jump right into it. I know you have a lot of content today and great information. So I did give a brief explanation in my intro, but maybe you could expand upon that a little bit. What are trusts, especially what is an irrevocable life insurance trust? Let's start there.
Absolutely. That sounds like a great place to start. And as we go through the presentation, couple things. If you have any specific questions, my contact information is on the screen. Please feel to reach out to me or any one of the other great team members here at E4. We are certainly happy to help you. Now, this topic is a very in-depth conversation, and trying to cover it in 10, 15 minutes is not easy. So as I move on to my next screen, like it shows there in the third bullet point, it's not meant to be all-encompassing. Today, I'm just trying to give everybody a high-level understanding of how ILITs work. And again, this is for advisor education. Myself, E4, we don't give legal or tax advice. So there's our fun disclaimer for the day before we hop into it. And our agenda, Jen, you kind of led us right into, what we're going to talk about today. So we'll start with what is a trust, and an irrevocable life insurance trust is one example of what a trust is. But in its purest and simplest form, a trust is a box. So if you think of my wonderful artwork that's on our screen right here, a trust is simply a box. You put things like assets into it. You work with your legal team, your attorney, specifically an estate planning attorney, on what you want that trust to do. What are the goals of the trust, and what is going to happen to trigger the assets coming out to the beneficiaries? So again, a simple thing that as you're working with clients, if you can just remember that one thing, draw out a square on a piece of paper. A trust is a box. Now, trustee off to the right, there is going to be a trustee that administers the trust. It's a very important part of any trust that you work with. And those are the people that are in charge of making sure that the trust is performing properly and ultimately the assets are being distributed per the donor's wish. So specifically with an irrevocable life insurance trust, and we'll get through as we talk today, what is, what's the purpose of an irrevocable life insurance trust. But as Jim mentioned in the introduction, it has a lot to do with federal estate taxes, because as when we pass away as individuals, as our clients pass away, there's a thing called a federal estate tax, and there's also a federal gift tax that goes with that as well. And essentially what that is it's a death tax. When we pass away, our assets go into our estate, depending on if we've done estate planning to begin with. You might use other types of trust, revocable living trust, charitable trust. There's all sorts of different ones out there. But ultimately, an irrevocable life insurance trust is outside of our personal estate. So assets that are in there are not included in an individual's estate when they pass away.
Excellent. So thank you for explaining to us a trust in its simplest form. And you touched on federal taxes and also gift taxes. I'd like to ask you about state taxes too, but before we do that, and you have it on your screen here, can you please tell us a bit more about federal gift and estate tax?
Absolutely. We'll touch on both those, what the estate tax is from both a federal, and some states have a state estate tax as well. So as you can see by the chart here, this goes back to 2010, all the way through what our current year is. Shows on the top chart there what the top rate for a transfer tax, or in this case an estate tax, would be, what the gift tax exemption and the estate tax exemption is. Typically outside of 2010, that gift tax and estate tax are going to mirror one another. So as you look back, all of a sudden things started at 1 million in 2010, jumped to 5 million in 2011, then went through kind of a pretty steady inflationary increase up until 2018, when former President Trump passed a legislative act that increased that all the way up to a little over 11 million. That's continued to grow. This year in 2022, it's 12.06 million that an individual can be worth prior to paying an estate tax. And for families, husbands and wives, they each have their own estate tax and gift tax exemption. So husband and wife combined, if planned appropriately, can be worth a little over $24 million before incurring a federal estate tax. So again, as we look at the concept of an ILIT and having wealth outside of your estate, there are certainly some benefits just with the traditional exemption there as well. Now moving over to a state estate tax, and I have one example on here because I know many of our advisors have clients in the state of Minnesota. So again, if you think federally, you can be worth roughly $12 million currently in 2022. In Minnesota, there's a separate state estate tax that starts at $3 million. Anything over $3 million. You can see the tax rate is lower. It ranges from 13 to 16%. And in the fourth bullet point, where it says may apply to non-residents that have Minnesota situs property. So if you have a lake home in Minnesota, if you have a farm or business interest in Minnesota, there could be a pro rata state estate tax for the state of Minnesota as well. So if that is you or your clients, certainly something you will want to pay attention to and know how that works within your planning. With that also comes the gift tax. And what is a gift tax annual exclusion? So essentially what that is in 2022, the gift tax annual exclusion is $16,000 per year per donee from each donor. So in simple form, if I've got two boys, me and my wife combined, we could gift $32,000 to each of our children. If you're a single person, it'd be 16, but you can take that exemption for families and tie that to each of your children. Now, it does require a present interest, which is what we'll get into regarding irrevocable life insurance trust and how that gift tax exclusion works. But Jennifer, you think should we just hop right into just kind of some illustrations on ILITs and how they work?
I think that's great. Great overview of the taxation. Yeah, let's get into that. How exactly an ILIT works.
All right. So again, an irrevocable life insurance trust is its own separate entity. It is not you. So if you think of in this image here on the left, you get the principal or the donor of the trust. They've got their own ILIT, which is, again, it's the purest, simplest form. It's a box, but now that is separate and outside of the estate. And it is the owner and the beneficiary of the life insurance policy in the form of an ILIT. So again, step one, you're going to gift equal premium payments to an ILIT every single year. That's going to fund that life insurance policy that the ILIT is the owner, the payer, and the beneficiary on. So you can utilize those annual gift exclusions, and it does not eat away at your gift exclusion or eat away at your estate limits. Now, to have that present interest that we talked about on the slide prior, again, because in my example, if I've got two kids, I gift $64,000 a year between me and my wife, both giving $16,000 per child into that ILIT. Both of our kids have to have present interest in that money. So what the attorney does, they work in conjunction with the trustee of the ILIT. They send out what's called a crummy notice to each of those beneficiaries of the trust. What that does is it gives the beneficiaries 30 days to claim that present interest of the money, which in the eyes of the IRS gives that beneficiary the present interest. Now, again, if you think of planning properly, in anybody's right mind, you're not going to take that small amount for the large amount of the life insurance that's going to pass away or pass along later on down the road. So the crummy notice, they are very important. They have to get things done appropriately. That's why you want to work with a good team. Once that time is passed, then the ILIT in step 3 sends the premium of insurance premium, the payment of insurance premium to the life insurance company. So that's how it works every year as you are setting up this ILIT. So that's during the funding years. Now let's move forward. And how does it work in all reality when the person passes away and the life insurance proceeds go? So as you can see by my excellent artwork, there's an X through the individual there. He or she has passed away. And step 1 in this at passing, the insurance proceeds fund to the ILIT, because again, the ILIT is also the beneficiary of this life insurance policy. And when those dollars come in from the life insurance, the ILIT or the trustee of the ILIT in particular is going to administer in accordance with the ILIT provision. So depending on the age of the kids, they may just be, hey, all the kids get their equal share. If there's provisions in that there is percentages at certain ages, that ILIT and the trustee is going to make sure that when an individual who set that up passes away, those distributions in step 3 to the children go in accordance to how they should really be working.
Excellent. So no incidents of ownership. The contract is owned by the ILIT. It then pays out to the beneficiaries, if you will, of the estate, correct?
Exactly.
A question about taxation, Steve. We're talking about when, the couple passes away. Is there estate taxes due when only one of the two pass away?
That's a great question, Jennifer. As it sits now, and again, estate tax laws are ever changing. So right now, again, long answer to your question. I'll try and make it a little brief, but each individual can be worth up to about $12 million if they pass away in 2022. Now, you do get an unlimited marital deduction. So you can pass an unlimited amount of assets to your spouse without incurring an estate tax.
Okay.
Now, with that provision, those exemptions are set to increase with inflation over the years. In 2026, this version of the estate tax law is set to sunset. So January 1st, 2026, if no other legislation is done, it's going to revert back to the pre-change. It'll be 5 million plus inflation. So we're figuring somewhere between 6 and 6.5 million is where to land come 2026. But to your question, when the first spouse passes, there is that unlimited deduction And you could get creative, because if you do have a very high net worth clients that you're working with, there's other types of trusts, such as disclaimer trusts or credit shelter trusts, that attorneys can draft up to help maximize that deduction as well.
Excellent. Thank you for that. Let's move on to why someone and when someone would consider using an ILIT.
Exactly. That sounds great. So I thought with that, we'll do just a quick case study of a case that happened last year in 2021. So again, this is a case that went right through E4 here. In this case, we had a husband and wife, both of them 53 years old. Between the two of them, there were 6 kids, and they had a combined net worth of about $45 million, of which it was very highly liquid. So they hadn't really done much planning. So the advisors, we had sat down with them and their attorneys and figured out their 2 main goals with their wealth. Again, they're young. That 45 million, they don't spend money. They are very conservative. That 45 million is going to continue to grow as they age. So really, their 2 main goals were to pass on wealth to their children and charities of their choice. And they wanted to minimize and ideally eliminate estate taxes at their passing. So throughout the process, again, an ILIT was just one of the pieces of this planning case, working hand in hand with others throughout E4, as well as the clients and their legal team. So really, if you think of this from a case study standpoint, prior to doing any planning, their estate was worth about 45 million. In this case, we carved out about 3.7 million of that. So there's 41.3 million left in the estate. 3.7 million, we actually pre-funded their ILIT because there was some big estate tax changes being proposed towards the end of 2021, where if that would have passed, any ILITs that were continually being funded or newly set up ILITs would be drawn back into the estate for at least a percentage of that death benefit. So based on the recommendation of the attorney, they wanted to fully fund it. So how we did that is we used a few different products. Being that the clients were 53, working through E4 and the informal underwriting process, we were able to get a second to die policy with Prudential, as you can see there in the green, for just under $26 million. Of that, each year the annual premium is $180,000. So it's set up to pay for the remainder of both spouses' lives to get the most death benefit. Now, to put this essentially in a lockbox and be done with it with that 3.7 million, the first year the clients paid that 180,000 to the ILIT. The crummy notices went out, so the kids had the present interest and the premiums were paid to Prudential. On top of that, they put about $1 million into the ILIT the Global Atlantic single premium immediate annuity that the ILIT was the owner and the beneficiary of. So every single years for years 2 through 6, that paid the 180,000 of premium to Prudential. So they got a little bit of leverage on their money there. And then we also utilized 2.7 million into a nationwide peak 10 annuity that is guaranteed from starting in year 7 when both clients are age 60 for the remainder of both of their lives to kick out the 180,000. Plus we also actually built in another, I think it was 2,100 in trustee fees to fully fund the ILIT for the remainder of the life. So clients turned a $45 million estate that's fully taxable beyond the exemption. Now they've got 41.3 million plus the 26 outside of it. So they've got now a roughly $66-67 million estate, of which almost 26 is free of estate tax. That can go to the kids. When they pass, they can utilize the remainder of their estate tax and gift tax exemption to get to the kids, and then the remainder can go to charities. So again, in theory, working closely with the attorney, they have saved millions upon millions of dollars in estate taxes by doing such. So last slide here, and then kind of get into when to consider ILITs. But again, the why. Things are those assets, those life insurance policies, they're income tax free, but now that they are owned by the ILIT, they're fully outside of the estate and free of estate taxes as well. Clients that are, very good to consider, obviously your high net worth clients, if they're at or close to being at the estate tax exemption amount, knowing that again, in a few years, that limit is going to drop, essentially in half. Clients with non-liquid assets, you think of the farm clients that you work with. Again, they might have a very, very highly valuable farm, but they don't have a whole lot of other liquid assets. How are they going to pay the estate tax? If they've got to sell off the farmland, it's going to be a fire sale and they're going to be getting pennies on the dollar when they do that. Obviously, we want to have somebody that's insurable. And if they've got the means to maximize that estate tax exemption while it's high, between, the next couple of years, I really truly believe that those ILITs are going to be a very highly utilized planning technique by advisors and attorneys. Because again, if you think of the example we went through in that case study, if you can fully fund that ILIT, find ways to get leverage and predictability with the products that we utilize in insurance and annuities, it is a fantastic way that clients can pass money on, not only income tax free, but also estate tax free.
Excellent. Thank you for that wonderful information, and also a great example case study of why planning is so important. So I think it's a great time to open it up for questions. As a reminder, you can use your chat box. You can also unmute your line. But while we're waiting to see if there are any final questions, I'd like to remind you that today's brew and our full library are recorded and shared on the BREW blog on our website at www.e4.insurance. And Steve, let's do our giveaway. Can you pick a number between 1 and 23?
1 and 23. I'm going to go with number 14.
Lucky number 14. Tony Sullivan is our winner. Congratulations, Tony. Be on the lookout for a complimentary CE voucher and a Starbucks gift card that will be coming your way from all of us here at E4 Insurance Services. So let's see about those questions now. Just bear with me. I think it's also great, Steve. Oh, go ahead.
I had a question for you. Nice job, Steve. That was great. I appreciated the case study too. But one question that I did have was, does the money distribution, when it goes through an ILIT, does it take longer to get to the actual beneficiary compared to just like a normal life insurance payout? Is there like a bigger time in between? Does that make sense what I'm asking?
Yeah, no, that's a great question, Tony. And realistically, the answer is undoubtedly going to be yes, because ultimately that money is making a stop first within the ILIT. It's going to go, and that trustee is going to have to look through the legal documents, make sure things are going to be administered. So as you're working with your clients and their team of advisors, oftentimes the attorneys are going to have trust companies that they're comfortable with working with. I've got several recommendations as well if anybody is ever in look of one. But that's where, again, each year you pay that trustee an annual fee to administer not only the ongoing crummy notices and other things while you're living, but ultimately when the rubber hits the road and that death benefit is paid out, you want to make sure that your beneficiaries are getting the money that you gifted to them. And so that's, in my mind, using a trustee, that's what they do. They work on trusts all day long. You want to have somebody that knows what they're doing. So that, to answer your question, it will a little bit, Tony, but if you've got a good trustee, it's going to, certainly expedite the process. It's not going to be nearly as long as, there's sometimes some horror stories of assets getting delayed for, months, if not years in probate. That's a whole nother topic for another day. But there will be a little bit just because of the legal piece within the ILIT. Hopefully that answered it.
Yep. Thank you.
Thanks for the question, Tony, and congratulations. Any other questions out there? All right. Well, thank you for a great presentation, Steve. It was wonderful to have you on. And we look forward to Everyone tuning in to next Wednesday as Danielle Schneider with Symetra shares a sneak peek of upcoming enhancements to Symetra's Swift Term. Danielle will share some real success stories and ideas of how Swift Term can help make your business more efficient. We'll see you again next week on The Brew. Thanks everyone for joining. Have a great week.